Thank you very much, Mr. Chairman, and thanks to both of our witnesses for joining us today. Appreciate your insight, and it's good to have you with us. Dr. Taylor, I was wondering if I could have you discuss how some of the following items might add to the cost of an open-ended quantitative easing process. Unwinding the enormous Fed balance, investments running into risky equities to chase return, creating an assumption that near-term government debt service costs are sustainable, overinvestment in a narrow set of growth assets and the creation of new bubbles, and misallocation of investments. Could you just talk to us about those for a moment?
Yes, Senator, thank you. That list is, I agree with each one of the points as a concern. Unwinding the balance sheet requires selling the mortgage-backed securities and selling the long-term assets. To the extent that has been beneficial, which is debatable, that will be counterproductive. It'll be a restrictive in the economy. It'll also be occurring at the same time. Most likely, the Fed needs to raise the short-term interest rate, and so it's always hard to exit from an easy monetary policy. This one will be hard than ever. So that creates risks. I say, and other on your list, which is important, it gives a potential for a false hope on the budget because it makes the interest rate payment so low at this point. Now, again, to the extent that it is holding rates down, it clearly is holding short rates down. I think the search for yield that you mentioned, that people are going to be taking on risky assets that they probably shouldn't have, that will come back to be a negative, as we've seen in the past. So all these, it seems to me, are serious risks that are being undertaken, and they may involve unfortunate policies going forward. For example, if the Fed is concerned about its balance sheet value, taking capital losses, that may delay its exit. They may hold on to those securities longer than they otherwise should. That's a very real possibility. On the other hand, if they hold on to those securities, it's going to require that they pay banks huge amounts of money for their reserves, because they're now paying interest on reserves. And if they want to have the short-term interest rate be 1%, 2%, 3%, whatever it'll have to be in the future, without reducing the balance sheet, it will have to pay all that money directly to the banks. That's going to be a concern as well. So I've been studying monetary policy a long time. Exits from these are always difficult, and this one is going to be more difficult than ever. And I believe that is already causing concerns about how it's going to unfold, which holds back the economy itself right now.
Thank you. Since the recession's technical end now several years ago, there has been some troubling correlation between the change in unemployment rate and the size of the labor force. And last week in the New York Times, economist Casey Mulligan noted, as unemployment has gone down, so has the labor force participation rate. In the midst of this trend, the Fed has set a new precedent. It set a new precedent on December 12th of last year by declaring an official unemployment target of 6.5%. based on headline unemployment. Given these circumstances, how useful do you think the headline unemployment is as a target?
Well, I think it's more suspect than usual as an indicator of overall demand conditions in the labor markets, because, as you say, people are dropping out of the labor force at a much higher rate than you would expect in the current circumstance. A while ago, the CBO estimated that the unemployment rate would be about 1.25% higher if labor force participation had behaved according to the way it should in these times. So it makes the unemployment rate more difficult to interpret, and is one of the reasons I think people are concerned about the focus on a particular number like that. The Fed has allowed itself wiggle room. It says, well, it's not a for sure thing. They will change on that basis, but it's one of the other uncertainties that is making monetary policy difficult to interpret right now.
Has measuring price stability changed in a similar way in recent history?
I don't think so. I think there's always the question about, for example, should they focus on a core inflation rate? I've always been worried about a core measure because ultimately you're concerned about the ultimate inflation rate. In other ways, you could average the inflation rate over a few quarters to get a better indicator. I think the statistical agencies should continue to try to improve their statistics, get better measures of inflation, but I don't think that is a major problem with monetary policy right now.
And then finally, would any of this, does any of this suggest that it might be easier from a technical perspective to enforce a single mandate? Oh, yeah, I see my time's expired. Yeah.
Would you like to answer, Dr. Taylor?
I think it would be better because it would remove a lot of the ways and reasons the Fed moves in these discretionary ways. As the chairman indicated, the dual mandate entered the law in 1977. It was at this period of a highly interventionist mentality with respect to policy. But as soon as Paul Volcker came in, it was continued by Alan Greenspan. They basically tried to interpret that law as get inflation down, get price stability, that will generate. And they were very successful in doing that. Now, really for the first time since the 1977 amendments, the Fed refers to it all the time as reasons to do this and reasons to do that. That, I think, is problematic. And that's one of the reasons I would think it'd be better to try to focus on a mandate, not to ignore what's happening in the economy, but to simplify what the Fed is actually doing.
Thank you very much.
Thank you. Senator Coates.